A company with no profits, burning through over $300 million a year in cash, trading at 60 times its annual revenue. 11 analysts looked at that and said, strong buy. That's not a typo. The consensus across Wall Street, the people whose entire job is not to be wrong about this stuff, is that Rocket Lab is one of the more attractive long-term bets in the market right now. And the price target from Bank of America sits at $120 a share. Now, the easy reaction is hype, momentum play, another growth story that ends badly when rates move or the narrative cracks. That reaction is not unreasonable, it just might be wrong. Because buried inside this company's filings, backlog, and contract structure is a specific bet that actually has a logical shape to it. It has a name, Neutron. And everything in this analysis eventually leads back to that single variable. We'll get there. First, though, most people's mental model of Rocket Lab is incomplete, and if you carry the wrong model into the numbers will mislead you. Most people think of Rocket Lab as the company that builds a small rocket called Electron. That's accurate, but it's like describing Apple as a company that makes phones. Electron is real, and it matters. 79 successful missions, a dominant position in the dedicated small launch market, a track record that most launch providers would take right now without negotiating. But Rocket Lab's revenue no longer comes primarily from putting things in orbit on Electron. The company also designs and builds complete satellites. It manufactures spacecraft components and sells them directly to third parties. It supplies hardware to NASA and the Department of Defense. About half of all revenue in 2025 came from U.S. government contracts. What this means structurally is that Rocket Lab has moved from being a service provider, you pay us, we launch your thing, toward being a vertically integrated space systems company. It builds most of what it uses. That reduces exposure to supplier disruptions. It captures margin at multiple points in the chain instead of one. And it creates a customer relationship that is harder to replace because the customer is buying a system, not a ticket. This distinction matters when you read the financials. A pure launch provider growing at 38% a year would tell one story. A company that builds, launches, and operates, and is now embedded in defense supply chains, tells a different one. The risks are different. The ceiling is different. The valuation logic is different. That's the model. Now look at the numbers with that in mind. Revenue hit $602 million in 2025. That's a record, up 38% from the year before, driven by 21 Electron launches and expanding satellite manufacturing work. Gross margins improved to the 34 to 44% range depending on how you measure it. Real progress from earlier years and moving in the right direction. The balance sheet is cleaner than the headlines suggest. Over $800 million in cash, roughly $265 million in debt, a current ratio above 4. Working capital is positive and healthy. This is not a company running out of road. Here's what's also true. Operating cash flow was negative $166 million. Free cash flow, what's actually left after capital expenditures, was negative $322 million. The net loss for the year came in at $198 million. And to maintain that cash position, the company raised over $1 billion by selling new shares. The dilution is real. It happened. It will likely happen again. I'm not going to dress that up. This is what a capital-intensive company looks like when it's building factories, developing a new rocket, and scaling a manufacturing operation simultaneously. The losses are not a sign of a broken business, but they are a condition. The current valuation only holds if growth continues to deliver and if the margin trajectory doesn't stall. Before we go further, what would it take for you to consider this a viable long-term hold? Not the analyst targets, not the backlog number, your threshold. Because the answer to that question determines whether everything that follows is useful to you or just interesting. A price-to-sales ratio of 60 sounds absurd until you understand what's underneath it. At the end of 2025, Rocket Lab carried a $1.85 billion backlog, up 73% in a single year. A large portion of that is locked-in defense revenue, including an $816 million contract from the Space Development Agency. Backlog is not a forecast. It's revenue that already exists on paper. The market is paying for that visibility and for the rate at which new contracts are arriving. The political environment is doing real work here too. The current administration has made commercial space a national security priority. Executive orders are pushing faster FAA launch approvals and expanding Space Force budgets. U.S.-China tension has made domestic launch capability something the government is willing to pay for consistently over years. Rocket Lab is one of a small number of companies positioned to absorb that spending. That's not a soft tailwind. It's a structural demand shift. But here's the honest read on the valuation. At around $68 a share, DCF models that account for backlog conversion and realistic Neutron-era growth put fair value somewhere near $74. Not dramatically expensive if everything goes right, not cheap by any reasonable measure. The stock is priced for execution, not for forgiveness. There's no margin of safety built in. What the price is actually buying you is a very specific bet. That Neutron flies, that it wins contracts, that margins expand fast enough to justify the current multiple before investor patience runs out. That bet has a name, and it's time to look at it directly. Neutron is a medium-lift rocket. First launch is currently targeted for late 2026, after a short delay caused by a tank test issue earlier this year. That context matters. This is not a program that imploded. It's a development program running into the friction that development programs run into. The reason Neutron changes everything is math. Electron carries small payloads. It earns what a small payload launch earns. Neutron can carry significantly more, which means larger commercial satellites, more lucrative government payloads, and contracts that Rocket Lab currently cannot bid on. Revenue per mission goes up sharply. The addressable market expands. And critically, the path to profitability, which currently requires Electron to keep scaling and margins to keep grinding upward, gets a major shortcut. Without Neutron, this is a good business growing steadily in a good industry. With it, the model becomes substantially more powerful. The risk is proportional to the upside. Neutron has never flown. Rocket development fails in ways that are expensive and public. SpaceX already owns the medium to heavy launch market and has no incentive to make room. Rocket Lab has government relationships and a defense backlog that give it a real shot at early contracts. But a shot is not a contract, and a contract is not revenue. One more data point worth sitting with. Insider ownership is about 1.65%, and recent insider transactions have been sales, not purchases. That's not a red flag on its own. Executives selling shares to cover tax obligations is standard, but it's not a bullish signal either. So here's the question I'd ask yourself. If Neutron slips another 12 months, not crashes, just slips, what does that do to your thesis? Does the rest of the business hold the story together? Or does the whole thing depend on that rocket flying on schedule? Hold that answer. It matters for what comes next. There are 3 ways this plays out over the next 3 to 5 years. I'll give you each one straight. Base case. Electron keeps flying. The backlog converts to revenue on roughly the expected schedule, and Neutron gets off the ground in late 2026 or early 2027. Revenue grows somewhere between 20 and 40% annually. Margins improve, but slowly. The company is still posting losses in 2027, closer to break-even in 2028. The stock delivers solid returns from here. Not spectacular, but consistent with a high-growth company that's executing. This is the most likely outcome. It requires nothing extraordinary, just continued delivery. Bull case. Neutron flies, performs, and wins a meaningful tranche of new defense and commercial contracts within 12 months of its first successful mission. Margins expand faster than the base case because medium-lift revenue carries better economics. Profitability arrives ahead of schedule. At that point, the stock re-rates aggressively. It could double or more from today's price. This outcome is not a fantasy. It requires execution on a compressed timeline against real competition, but the customer relationships are in place and the demand is real. Bear case. Further delays on Neutron, or a high-profile electron failure, or both. Cash burn accelerates. Another large share offering dilutes existing holders at a lower price. The stock, at 60 times sales with a deteriorating narrative, is exposed to a sharp correction. Not because the company is broken, but because that valuation price contains almost no tolerance for setback. This outcome doesn't require disaster. Delay is enough. The right question here is not which scenario you hope for, it's which scenario you have sized for. A position that works in the base case and survives the bear case is a very different position from one that only makes sense if the bull case arrives on time. Drop your scenario call in the comments. Base, bull, or bear, and why. I'm genuinely curious what you see in these numbers that I might have weighted differently. Here's the clean version of what we've covered. Rocket Lab is not a stock you buy because the numbers already work. It's a stock you buy because you have a specific view that they will work, and you understand the condition that has to be met for that to happen. The backlog is real. The balance sheet is solid. The margin trend is moving. The political and defense tailwinds are structural, and all of it sits underneath one question. Does Neutron fly, and does it win? If your answer is yes with conviction and a position sized for volatility, the long-term case holds. If your answer is, I think so, maybe, size accordingly. This video is for educational purposes only and does not constitute financial advice. Nothing here should be taken as a recommendation to buy, sell, or hold any security. Do your own research and make your own decisions. You're the one accountable for them.